Hello, and welcome to the All-in-One Loan Consumer and Referral Partner presentation. Today, we're going to be covering what the All-in-One Loan is, a little bit about how it works, and some additional information to give you an idea if this is going to be a product that you can benefit from in your household or in your business. It's likely you received this presentation from a loan officer. So if you have any questions on any of the information that we're going over today, I do recommend that you reach out to your loan officer for additional guidance. So with that, let's go ahead and get started. If you've never heard about what the all-in-one loan is, I would love to introduce it to you. The all-in-one loan is a first lien position, 30-year term, open-ended mortgage that is combined with a full functioning zero balance sweep checking account. It's home financing and personal banking combined. This allows consumers to achieve things that traditional financing was unfortunately never intended for you to experience. And we use the term a financial tool because that's absolutely what it becomes. So, in today's presentation, again, we're going to be going over in detail about what the all in one loan is and what makes it so unique. And I would encourage you, just as our customers do in that blurb right there, to open your mind to more than just interest rates, especially when it comes to financing, because this product is about so much more. There are four characteristics that are automatic in this product that I want you to keep in mind as we go through today's presentation. The first being that the all in one loan is going to lower your costs, your overall real estate costs, without depending on lower rates. Right now, as consumers, lowering our cost is really dependent upon interest rates, unfortunately. And as consumers, we chase interest rates. We believe that if we have a low interest rate and we have a good monthly payment, we must be getting a good deal. And I would encourage everyone to think about the calculation of interest, not just the interest rate being what matters most. So the all in one loan is absolutely going to reduce your overall cost of real estate without you having to chase those interest rates. The all in one loan is going to lower your monthly payment automatically during the loan, again, without you needing to refinance. In today's market, if you wanted to have a lower monthly payment, that means you would have to refinance into a lower interest rate. And hopefully, appreciation is keeping up in your area so that you can continue to recycle or refinance that debt every 5 to 7 years, which ends up being the national average. But again, the all in one's going to lower those payments for you, and you're not going to need to refinance to experience that. The all in one loan is going to provide you fewer total payments compared to traditional financing. And right now in today's market, if we wanted to reduce the amount of payments that we had to make, we would typically get a shorter term. So instead of a 30-year, we would get a 15-year. The unfortunate thing about that is going to increase our monthly obligation for that financing. So we oftentimes don't refinance into a shorter term. But the all in one's going to provide that reduction in total payments without, again, needing to refinance. And lastly, the all in one loan is going to give you 24/7 access to available equity dollars without needing to refinance or without you needing to get a second mortgage, typically a second lien HELOC. It's going to prevent you from needing to do that because you will have that instant access to equity. So please keep these four things in mind as we move forward. Now, to understand why the all in one loan is so different, let's put it into context and compare that to a traditional mortgage. This would be your 30-year fixed rate mortgage, your 20-year fixed rate mortgage, 15-year, 10-year fixed mortgage. Even ARMs have this type of amortized repayment schedule. An amortized repayment schedule is the interest calculation of what that monthly payment's going to be. And the monthly payment in a traditional loan is consistent throughout the term. Now, when you break down what that monthly payment consists of, it's a portion towards interest and a portion towards principal. In a 30-year fixed rate mortgage, which is the example you see on the screen, by year 10, for every $100 spent on that payment, only $23 of that 100 went towards principal balance reduction. The rest of that payment went towards interest cost. So amortized repayment schedules are heavy in interest first. Now, keep in mind in how consumers act, and I myself am a consumer. We typically will refinance or recycle our debt every 5 to 7 years. So if we're not even staying in our loans for 10 years before we refinance them, those numbers get worse. We're just restarting that clock back at square one, where the bulk of our payment now is still going towards interest versus principal balance reduction. And the kicker is by year 21, about 50% of the loan balance is still unpaid. Half of a 30-year term is 15 years. But that doesn't mean you're going to be at a 50% mark at that point. You got to add an additional 6 years, and then you'll have 50% unpaid. So the amortized repayment schedule, although has been very helpful for folks to get into homes, it's been around since 1938. I would argue that a consumer from 1938 has different needs than a consumer in 2025. Yet we haven't updated or innovated mortgages in how they're repaid since 1938. So there's absolutely now is the time to rethink how we repay mortgages. Now, the mathematical equation for whether that's a debt that you're financing or whether that's an investment that you're making, there's typically three components. You have the rate, you have the principal balance, and then you have the time or term. And this is true for mortgage financing as well. Now, interest rates, they tend to be the one thing we can't control and we have no control over. But we have the interest rates as the main driver of the decisions that we make when it comes to our financing. Now, I can't control interest rates. You can't control interest rates. Our activity in the market can influence them, but we by no means control them. The idea behind the all-in-one loan is to control the controllables. What can we control? It's not the interest rate. What we can control is the principal balance. And by giving consumers the ability to pay the principal balance first before we even calculate interest, mathematical byproduct of that is going to be a reduction in time that you're in debt. And that mathematical byproduct is going to be a reduction in interest costs that are associated with the item you're financing, in this case, a home. So by controlling what we can control, which is the balance or the principal due, that allows us to change that equation and make financing more effective and efficient. So as I said earlier, the all-in-one loan is home financing and personal banking combined. And as consumers in America, we typically don't think about our checking accounts speaking to our mortgages. How does that make sense? But as consumers, we're used to bundling things. We bundle our auto insurance and our home insurance together under one provider to make it easier and efficient. We bundle our cable and our internet together with one provider because it's more efficient. And there's many other examples out there. So why not take two financial instruments that we utilize all the time and bundle them together to get the benefit of it? So when it comes to your checking account on the all-in-one loan, you're going to have a Visa card, or it's a card backed by Visa, as well as the star logo. So you can use it at about 2 million ATMs nationwide, and you can use it anywhere Visa's accepted. You can order personal checks. There's online banking. There's bill pay. There's fraud protection features. There's auto alerts. There's a mobile banking app. So you can take a picture of your check directly from your phone and deposit it into your all-in-one account. So that all of the features that you're used to having in a traditional checking account are going to be present in the all-in-one loan. But how does this work? How does bundling the accounts make sense? Well, we've enabled a sweep banking feature. And the sweep banking feature allows the money that's in the checking account to go towards that principal balance. Let me demonstrate that. If you made a deposit into your all-in-one account, it doesn't matter the amount, it doesn't matter the frequency. When a deposit is made into the all-in-one account at 12 a.m., that is going to sweep to the mortgage side of the account, and it's going to reduce the balance by the amount of the deposit. Easy enough. You make a deposit, reduces the balance by the amount of the deposit. Oftentimes, I have customers stop me right here and they say, Erin, okay, I get it. That makes sense. But I can't see myself putting my whole paycheck towards my mortgage. I've got groceries to buy, I've got bills to pay, I have activities I need to put my kids into. This sounds good, but again, I can't see myself putting my entire paycheck towards my mortgage. And I agree with that person. They should absolutely buy those groceries. They should pay those bills. They should put those kids in the activities. Again, whatever it is you're doing today, do tomorrow in the all in one loan. But until you need to spend that money, let it work for you to keep the balance low. And what I mean by that is how we calculate interest. We're not predetermining the interest cost you owe on your mortgage. We're allowing you as the consumer to control the balance that interest is calculated off of. It's pretty substantial. So, what we do after the sweep happens and the balance reduces, every single night, we're going to take a calculation. Now, we don't charge daily, we calculate daily. So, every night after the sweep happens and the balance reduces, we're going to take that new lower balance, we're going to times it by the interest rate, and then we're going to divide by 365. That becomes that day's interest cost. We do that calculation every single day of the month. When the month is over, we will add up those daily calculations, and that's the interest portion that gets auto drafted the following month. So we're calculating interest simply. You're paying it in arrears. It's the only loan in America that will take their interest in arrears. All others take it first and upfront. What's really important to understand with this particular slide is that we've separated the principal payment from the interest payment. Yes, you should still have a budgeted payment to repay the debt, what you leave in the account to keep that balance low, that payment. But instead of sending that payment to the bank where they split it between principal and interest, you leave that payment deposited into the account to continually keep that balance low. So we've separated principal payments from interest payments. They happen in two separate events. Every time a deposit is made, that is a principal balance payment. We calculate the interest daily, add it up at the end of the month. It becomes due the following month. That's when interest is due or paid. So this is a principal paid first product, and interest is paid in arrears. That methodology allows consumers to, again, achieve things with their financing that traditional lending wasn't intended for you to achieve. Most noticeably, you're going to have a reduction in overall interest cost, which is lowering your effective rate. That means that you don't have to depend on interest rates lowering to take advantage of a lower effective rate. Your money is working for you in that sense. You're able to build equity faster without changing your spending habits, your budget, or your lifestyle because you're so significantly reducing that debt. And you also get access to your equity dollars without needing to refinance. And so this becomes what I like to call an unintentional safety net because you have it available for you to use as you need to. You don't need to worry about trying to qualify for another loan. Now, how the loan is structured is also really important to understand. And it is a 30-year term, it's a 30-year draw. But you'll notice after year 10, the credit limit starts to reduce every month. And we do that starting year 11, month one. We reduce the available credit line by 1 over 240, or the loan amount divided by 240, because there's 240 months in 20 years. So, however you want to mathematically arrive at that. Now, oftentimes, folks are achieving their payoff anywhere between 8 to 12 years, but that's just the average. We have some folks that pay off in 2 to 3 years. We have others that have been in the loan for coming up on 20 years now, but they continue to stay in the loan because of the flexibility and optionality it offers. In fact, in the last 20 years, we have had 0 defaults on the loan. So we must be doing something right because that's not something that you would hear Fannie Mae or Freddie Mac or FHA or VA or even USDA being able to say. And that's because this product sets folks up for success. Now, I often say that this product is also as individualistic as the family and household that has it. If you get into this loan because you want to be mortgage free or debt free, fantastic. The loan's going to help get you there and quicker and more efficiently. But if 5 or 6 years down the line, you change your mind and you say to yourself, I think I'd like to buy some property. I think I'd like to invest in a business. I think I would like to do X, Y, or Z with my equity dollars to build wealth. You absolutely can do that too. The loan will allow you to do that as long as you have those available equity dollars. What you're seeing on the screen is a perfect example of how a consumer has used the account for several times throughout the course of the 30-year term. They paid it off a few times, but they still had it available to use if in the event they needed or wanted to. So this platform banking, consolidated mortgage and banking, it definitely changes the game for a lot of homeowners out there in America. Again, you're going to have all of the access features that you're used to and that you're already proficient at using. And you will experience your account activation usually about 4 to 6 weeks after the loan funds. There is some post-closing onboarding items that need to happen. And so we want to make sure that we're setting that expectation up front and as early as possible. Now, the all-in-one loan, with it being its 20th year this year, we've got a few different versions. So let's take a look at each one to determine which is going to be best suited for you. We have our standard AIO product, which is for primary residences, with the exception of Texas, primary residences, second homes, and investment properties in all states. Standard AIO is a 30-year term and a 30-year draw. So after year 10, starting year 11, month one, that available credit is going to start to reduce slightly, but you will still have available equity that you can draw on if you need to. Standard AIO comes with a sweep feature, meaning that all of the deposits that are made into the checking account are going to automatically sweep to the line of credit. There is no additional steps that you're going to need to take. That will happen at 12 a.m. every night. There is no prepayment penalty. There is no balloon payment. The all-in-one loan was designed to help folks carry mortgage debt more effectively and efficiently, and with less interest costs. So there is no balloon payment or prepayment penalty. Interest is always paid in arrears. The all-in-one daily interest calculation will deduct those interest costs the following month around the 21st automatically. So again, you're not going to have to send in a payment. It's taken care of all within the account. And standard AIO will also allow you to go up to a 90% loan to value. This is perfect for those purchase transactions or rate term refi situations. There is no cash out allowed above 80%, but on a primary residence, we can go to a 90%, and there will be an upfront MI premium. And again, your loan officer can go over all of those details with you if that's what you're in the market for exploring. Next, we have our Texas homestead. This is for primary residences in Texas. And Texas is an interesting state. They have some what they call A6 laws that are applicable to primary residences, especially when it's attached to a line of credit. So the Texas homestead version is still a 30-year term. However, it's only a 25-year draw. The very last 5 years, so month 300 to month 360, is going to be fixed if there is a balance. If the customers are at a zero balance and they want to pay off, they can close out the account at month 300 if they'd like. But whatever the interest rate is at 300 and whatever the balance is at month 300, that will amortize for the remaining 5 years. Texas Homestead does not have a sweep feature. And I think this is really great because it gives Texas Homestead folks some choice. You can decide how much of your deposit you want to go to the line of credit instead of having all of it sweep to the line of credit. You have the ability to keep some in the checking account if you would like. And that's all facilitated in the online portal. The minimum advance from the line of credit is $4,000. Now, that advance can be higher than $4,000, but $4,000 is the minimum amount that can be advanced from the line of credit at any given time. Interest that is due on Texas Homestead is not auto drafted from the line of credit automatically. That needs to be paid from the checking account or from an external account. And that is because of, again, those A6 laws. We want to make sure that we are compliant and we cannot auto draft interest costs from the line of credit in a Texas Homestead. That leads me to the very last point, per diem interest. On a Texas homestead loan, you would have to come into closing for the interest for the days of the month that are left from funding. So, as an example, if I closed my Texas homestead AIO on January 25th, I would have to pay for that 7 days worth of interest to get me from the 25th to the 31st, because again, we can't auto draft that from the line of credit automatically. And then lastly, we have a one-time close all-in-one loan. So this is for folks that are doing new construction or are doing a complete tear down to the foundation, and even removing the foundation in some instances. So a complete build up. It's still the same standard all-in-one loan product where you have the sweep feature, where you get to use it as a checking account. Bills and expenses can come in and out of it. However, there is a draw schedule that's going to be attached. So, based on the builder's draw schedule, that's when we're going to make available that portion or those portions of the approved line of credit. The all in one time close does have a contingency reserve requirement. And if there is enough available in the ratios or in the loan to finance it, you're more than welcome to do that. We do the all-in-one time close as purchase or refinance based on your ownership of the lot. So if you're purchasing the lot with the construction financing, that would be considered a purchase. If you already own the lot and you're either paying off the lien or you own it free and clear, that's going to be considered a refinance. So we consider these as purchase and refinance based on your ownership of the lot. Again, this is for ground up construction. You cannot use the AIO one-time close for renovation loans. This is for complete ground up construction or complete demo and rebuild. Now, getting into pricing and underwriting, just so that you can be armed with a little bit more information as you continue your conversation with your loan officer or your referral partner. The all-in-one loan is a monthly adjustable loan, which means the interest rate is going to adjust up or down each month, depending on the index. There is, I should say, a lifetime cap of 6% above your initial rate. So whatever your initial rate is at that you close with, 6% above that is as high as it would ever go. Now, there are two components that make up your interest rate. We have an index and a margin. The index that we use is the 30-day average SOFR, and that is a benchmark index. That means it's going to trend very similarly to the Fed funds rate, and that's averaged about around 2% historically. You also have margins, or a margin option, I should say. Our ranges are 2.5% to 4%, and the margin that you choose is going to be dependent on the conversation you have with your loan officer. So your margin will stay consistent through the life of the loan, and it's the index that can adjust each month. You add your margin to your index, and that equals your interest rate. Taxes and insurance, or impounds, as it's very frequently called, are not allowed on the all-in-one. You want to make sure that you are paying your property taxes and your insurance on time and to the correct location. And if you think about it, that goes along with the efficiency of the product. We feel you're going to get more bandwidth by keeping those dollars in your all-in-one account, keeping your balance low, that the interest is calculated off of, and then just paying them when they're due. So if you're unsure of how to pay your property taxes and insurance on your own without having an impound account, talk to your loan officer and they can help walk you through what that looks like. This product is manually underwritten, and we do follow Fannie to a certain extent, and we do have some additional items that we require that Fannie wouldn't. But we do follow state and federal ability to repay standards. So we are still subject to RESPA and many other compliance laws, although this is not a TRID compliant loan. When it comes to the reserve requirement, it can be higher than traditional financing, but we are somewhat flexible with the accounts you can use for the reserves. We can use 100% value of a 401k. We can use the cash value of a life insurance policy. We can even use gold and silver with the proper documentation for the reserve requirement. So check with your loan officer on what you have for reserves to see if that's going to be usable. Our debt to income ratio is pretty low. 40% typically is the minimum or the maximum, rather. 40% DTI, and that will allow you to do the 10% of reserves. We can go up to a 43% DTI, but that's also going to require 15% of the line amount in reserves. So think of your DTI and your reserve requirement as going hand in hand. Again, if you are unsure of what your debt to income ratio is, speak with your loan officer and they can help get you to what that figure looks like. And then just a few more items for folks that are self-employed and have really good tax preparers. Sometimes doing a full manual underwrite, it can be stressful. But just know we do have an asset depletion feature that you can use in conjunction with your income or as a standalone income qualifier. Based on the type of asset account that it is, we can apply a formula to determine what the income could be used for qualifying. So if that's a feature that you want to take advantage of, make sure you talk to your loan officer about that. When it comes to cash out transactions, we only require 6-month title seasoning. So as long as you've been on title for 6 months, we can do the loan as a cash out transaction. We also have a delayed financing feature. So if you are purchasing a property for cash outright and you want to be reimbursed the funds that you used to purchase that property, you can use the all-in-one loan for that delayed financing. You also can close the all-in-one loan in your name or in the name of an approved trust. You cannot close your AIO loan in the name of an LLC. And we would recommend that you do not deed it into an LLC post closing because, as part of the note that you sign, you're agreeing to keep the property in your name or in the name of a trust. LLCs are viewed as companies or corporations. So, changing the title of a property from an individual or a trust to an LLC is viewed as changing ownership, and that could be a reason for the loan to be called due. So please be sure that if you have a property that's in an LLC, we unfortunately can only close it if it's in a trust or in the borrower's name. All right, what are your next steps? If you reached or if you had a loan officer send this link to you to review what the product was and you want to dive in deeper, reach out to the loan officer that shared this with you and let them know that you're interested in exploring this as a option to either offer in your business or to use for your own household. I would highly advise everybody go through the interactive simulator. If you go to our website, allinOneLoan.com, and click on the Calculate Savings link, you'll be able to run a comparison of the all-in-one loan to either the loan you currently have or a loan you're considering taking out. And it'll be able to tell you, based on how you're going to interface with the account, how well the product could potentially work for you. There are a lot of features and a lot of logic behind the scenes in the simulator, so I do recommend that you go through that with your loan officer, but you can also navigate it on your own if you would like. If you want to see how this product has changed the lives of consumers or professional and industry professionals alike, go to our website, allinOneLoan.com, and click on testimonials. We have several that you can read through, from consumers to industry professionals. And we also have some videos on the homepage where you'll be able to hear those testimonials as well. If you want additional collateral to look at, we've got articles, we've got white papers, we've got case studies, we have frequently asked questions documents, we have brochures. The loan officers you're working with are armed with a lot of collateral to be able to share with you, depending on what your questions are or how you want to explore utilizing the all-in-one loan for your own household or business. And that's going to conclude this session. I hope that it was helpful. I hope that you learned something, and we do hope to earn your business in the future. Again, if you want to move forward with this product or if you have additional questions, please reach out to your loan officer. They have a support team that is able to assist them with any questions that may come up or any scenarios that they may need to work through. So please lean on them, and we're happy to help share the all-in-one loan with everyone that's interested. Thank you again for your time, and we look forward to working with you soon. I hope you all have a wonderful day.